everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. First one for 2025, and we're going to say five alive. Where is the Treasury 10-year yield headed? And we've talked about a return to a normal U.S. interest rate setting, but the most obvious question that comes to mind is, where is that 10-year yield going to? And we've heard a lot of conjecture at this point, and as we begin the new year, there's been a return to the 5% threshold coming in as perhaps one of the more interesting tidbits. And against that backdrop, I thought it would be a useful exercise to provide you all with some perspective and what I feel investors should be looking for in the year ahead. And in my opinion, and we've talked about this before, when trying to determine where yields may be going, one should start at the cornerstone for rates, and that's the macro Fed landscape. Now, our baseline case looks for the U.S. economy to continue on a moderate growth path, further improvement on the inflation front, but proving to be a bit bumpy, to borrow Fed Chairman Powell's description. But these two forces have now put the Fed on a path for only two more rate cuts in 2025, and that's based on the December FOMC dot plot. Now, post-election, the money and bond markets have been trying to also determine how upcoming fiscal policy will fit into the equation. However, this aspect and its potential impact on rates carries more uncertainty. Tariffs can arguably be more easily and quickly implemented, and any legislative initiatives take more time and may not be in the books until after mid-year at the earliest. So against that backdrop, let's go back to the macro Fed setting and look at some history for some guidance. And what you find out if you go back to, say, 1995 and the last 30 years, how did the 10-year Treasury trade? And let me ask you a question. What do you think is an outlier here? Is it the 1995-97 period when yields were 6 to 8%? Or was it the 2008 to late 2022 period when the yield fell below 4% during the financial crisis and Great Recession and ultimately plummeted to a COVID low of about 0.5% before beginning the ascent to where we are today? Now, I would argue those two periods are the outliers, and what lies in between is a trading range of roughly 4 to 5%. And not only is the macro Fed backdrop conducive for this trading band, but history once again can teach us another lesson. And that's if you look specifically at the spread between the Fed funds rate and the 10-year Treasury yield. And the long on average there is about 130 basis points. In other words, the U.S. 10-year yield is higher than the rate for overnight money. Now, investors have recently witnessed the Treasury yield curve uninverting and moving back into positive territory. And as I'm speaking to you here today, that Fed funds 10-year spread comes in at about, let's say, plus about 15 basis points. And based on the FOMC's December summary of economic projections, the median estimate for Fed funds is to drop to 3.9% this year. So let's think about this. If the curve continues to steepen in the new year, which is our base case, and gravitates towards its long-run average, the math tells us the 10-year yield could be poised to reach 5%, maybe even a touch above. Now remember, since the December Fed meeting, the U.S. 20 and 30-year yields have already reached high water marks of about 4.90 and a little bit over 4.80 respectively. And perhaps the Treasury 10-year is going to join that parade, where ultimately the longest end of the Treasury yield curve all trades at or above 5% here in 2025. So that's going to do it for me. I hope everybody has a great rest of the week. Take care and be well.